mentioned the value spread a little earlier before. I know you interviewed Cliff Asness, I think, a year or two ago, which was really good. And I see he just put out another update of his value spread. I think we've gone from something like the 99th or 98th percentile to the 94th.
Yeah.
And one of the things we spoke about a year and a half ago with the value spread was one of the arguments that's out there all the time saying that the spread should be wide is, interest rates are really low, and that's obviously changed a fair bit as well. Do you have any sort of comments on where those couple of things sit at the moment and how you think that might impact what you're doing?
Yeah, so what drives the spread? I don't know. I like the interest rate argument. I think that just too low interest rates push up the more overvalued stuff well beyond sort of any sensible level. And there's this argument that it's this duration. They call it duration, which is like a bond investing term. So something that is short duration. So if you think about the treasuries, US government treasuries, they're supposed to be risk-free. Like that's the substitution for the risk-free rate. They're not risk-free. But what they are is they're supposed to be default risk-free. The US government, it has defaulted, but for the sake of this academic exercise, the way that everybody thinks about it, it's the lowest risk option in the market is the way that you're supposed to think about these things. So you're taking risk off the table when you're looking at this. All that you're looking at is the length of time that you have your money in these instruments. And so you can put it out there for a very short period of time, days, or you can put it out for a very long period of time, 30 years. And interest rates will, this is like introductory finance 101. Interest rates will impact the 30-year treasury. Movements in the interest rates will affect the 30-year treasury more than they impact the short-term one. And you can build a simple model and discover this for yourself. This is just the case. So when interest rates go down, the 30-year treasury goes up a lot. When interest rates go up, the 30-year treasury goes down a lot, and certainly relative to the shorter term stuff. And so what people were saying, and I like this argument. What they were saying was that the growth stocks, they don't have any cash flows now. All of their cash flows are back end loaded. You have to look a long way out. And so they're more like a 30-year treasury. And growth stocks, they are earning all of their cash flows now, but the concern is usually that the cash flows are declining, like they're not as good as these other businesses. And so the cash flows are front end loaded. They're much more like those short term duration. And so the interest rate moves don't affect them as much. So when interest rates went down, the growthier stocks, which are like the 30-year treasury, went up a lot, and value stocks sort of weren't impacted much or as much. I like that argument. Cliff has sort of looked at it, or his colleagues have looked at it through lots of different, they've looked at the interest rate term structure, the absolute rate of interest rates, different rates. They couldn't find any sort of connection between the movements in the rates and the performance of these stocks. So have to be skeptical of that idea, even though I kind of like it. The other thing is, I just think from a business perspective, if money is sort of abundant, if it's easy to get access to a whole lot of money, then ideas that have a lower threshold, or have a low threshold for working out. So if you have a project that you expect it'll return 10% a year, and interest rates are at 5%, that project is worth 2 times your money put into a 5% interest rate. But if you have one that's worth 5%, can deliver 5% a year, it's worth 1 times, and you might not do it. You might not want to take on the risk. But if rates are at 1% and you've got a 5% project, now that 5% project is all of a sudden something that might be worth looking into, and you rationally invest in that because you get a better return than you do out of low interest rates. And I think that's a lot of what happened. No, it's not as straightforward and simple as that when you're making any individual decision, but collectively across the entire economy, with everybody making these investment decisions, lower rates just mean higher asset prices, and it means marginal projects get funded that wouldn't otherwise be funded. And I kind of think that's what happened. You're looking for a return somewhere because the rates are so low. I think they were probably below the rate of inflation, even though the headline rate of inflation was whatever it was. The actual real rate of inflation that people experience was higher than the interest rates that they could earn. And so they were encouraged up the risk curve to sort of get enough return to keep up with the market. And then they look at what's working. And really the only thing that was working was large US equities and this sort of speculative tech type stuff. And so it just drove an enormous amount of money into it, and it becomes self-reinforcing. So I don't know if you remember that it's before your time, but in .com 1.0, there was this very famous fund management group. It was just like ARK. They were called Janus funds, named after the god, the two-faced god. But they had this problem where they were performing well because they were sticking a whole lot of money into the market, which would produce, just by sheer weight of the amount of money that they were sticking into the market, they would push up these small tech issues. And then that would appear as good performance, which would help them raise more money, and they'd stick more into these tech issues. And then it got to a point where they just saturated the market and it reversed. And then, of course, the same thing happened in reverse that had happened on the way up. And that market, their holdings were down 99% or something like that. I think the same thing has happened with ARK. They tended to invest in smaller, lower float businesses, and that pushed them up. That turned out as great performance and more money flowed in. And that buy the dip mentality had just worked for so long, where anybody who had any ounce of fear was just sort of blown out of that market. If you had hedged or invested in anything other than those biggest tech stocks, then you were underperforming. And only the people who were like the highest risk people in the market were keeping up or doing better than the market. And then, of course, that's reversed. And I don't think it's over for ARK yet either. I think ARK's about, in terms of time, they topped out in February 21. I think it was 156 at the peak. I don't know where they are now, but they're between 30 and 40, something like that now. So they're down, whatever that is, 80%, something like that from the peak. If I look at their portfolio, I still think that they could easily come down another half from here across that portfolio, which would be 90% peak to trough. So I think that's, it all feeds on itself. It's all related. It's interest rates, and it's interest rates just being set too low, interest rates being moved lower, and then people sort of seeing that happen and then forcing money into it. And it creates these uber bubbles, and then the reversal is just as nasty, and I don't think it's over yet.
If you enjoyed this clip, check out the full episode here and subscribe here. Thanks for watching.